On July 22nd, 2026, a company reported the largest quarterly profit any corporation has ever posted, $112.1 billion. In 90 days, the stock fell 7%. And that drop wasn't the market getting it wrong. It was the opposite. It was the reaction of people who read the footnotes and understood three things the headline was hiding. First, almost 90% of that record profit wasn't real money. Second, for the first time since its 2004 IPO, this company burned more cash than it generated. And third, the important one, it may be building the most defensible position in the entire artificial intelligence industry, and the market still doesn't know how to price it. The company is Alphabet. And to understand why its best quarter ever got punished, you first have to understand what actually happens in the 1 second between typing a question and getting an answer. You type a question, you hit enter. A second later, you have 3 organized paragraphs assembled from dozens of sources on a topic nobody ever combined in that exact order before. That answer didn't exist anywhere on the internet until you asked for it. It was manufactured for you and destroyed when it was done. Underneath that 1 second, there are 3 stages, and each one has a different owner of the cost. Stage 1, training. A language model does exactly one thing. It predicts what comes next. The next word, the next frame, the next step. Everything else is a consequence of doing that extremely well. To get there, you show it an absurd amount of text and ask it, trillions of times, to guess the next word. When it's wrong, it gets corrected. When it's right, it gets reinforced. What's left at the end is a file of numbers, the parameters that encode everything it learned. More data, more chips, more time, better predictions, and more money. This is the stage where OpenAI and Anthropic burn capital. Stage 2, fine-tuning. Almost nobody talks about this one, and it's where the commercial magic happens. A freshly trained model has no idea what a useful answer looks like. It knows how to predict. It doesn't know how to serve. This is where it learns format, tone, and limits. And something more important, how to break a complicated problem into steps, solve them one at a time, and put the answer back together. This is also where distillation happens. You take a giant, expensive model, put it to work on millions of problems, and have a small model copy not just its answers, but its reasoning. That's how every lab ends up with an entire family of models at different sizes and price points. Stage 3, inference. And here's the twist. Training happens once. Fine-tuning happens periodically. Inference happens every single time someone hits enter. And here's what almost nobody understands about this business. In training, the company decides what it spends. How many chips, how much data, how much time. In inference, the customer decides what the company spends. The length of your question, its complexity, how many times a day you ask, whether the model has to search the web or write code or spin up copies of itself to work in parallel. Read that again. The more successful an AI company becomes, the more expensive it becomes to itself. Success doesn't lower the cost. It multiplies it. Training and inference are physically different jobs. Training is a coordination problem. Thousands of extremely powerful chips moving as a single machine, with none of them sitting idle waiting on another. Inference is a logistics problem, pulling billions of parameters out of memory and returning an answer as cheaply as possible, billions of times a day. That's why the industry split into layers, and each layer has its kings. The models, OpenAI, Anthropic, Meta, chip design, NVIDIA, AMD, Broadcom, manufacturing, TSMC, Samsung, SK Hynix, Micron, Intel, data centers, CoreWeave, Nebius, IREN, networking, Arista, Coherent, Lumentum. When you hit enter, hundreds of companies collect a fraction of a cent for making that second possible. There's exactly one company that owns every layer at once. It owns the browser, Chrome, the model, Gemini, the chips, the TPUs, which have been running in its servers since 2015 and were unveiled commercially in 2016. 6 years before ChatGPT existed, the data centers, the fiber optic network, including private undersea cables it paid to lay itself, and the platform you're probably watching this on. Others come close. Microsoft has its Maya chips, it has Azure, it has Windows and Office. But for the heaviest lifting, it depends on OpenAI's models. Amazon has Trainium and it has AWS. But it placed its model bet by investing in Anthropic, a company it doesn't control. Google is the only one that doesn't have to ask anyone's permission. And that means something very concrete. If one layer becomes the bottleneck, that's where the engineering goes. If somebody invents something better at any layer, Google integrates it without renegotiating a contract. The question for an investor is whether that's worth what it costs. There are two answers, the technical one and the financial one. They go in that order because the second one makes no sense without the first. On June 3rd, 2026, Alphabet published an investor presentation marking a decade of its TP use, and it shows exactly what vertical integration buys you. Remember that training and inference are different jobs? Google was the first to make the obvious, radical call. It split its chip in two. At Cloud Next, on April 22nd, 2026, it introduced its 8th generation of TPUs as two separate products. The 8T, designed with Broadcom for training, nearly 3 times the raw compute of the previous generation. And the 8i, designed with MediaTek exclusively for inference, 80% better performance per dollar than its predecessor. No other chip maker did that. And Google could only do it because it owns the chip and the model that runs on it and the data center it lives in. The result, in their own words, over the course of 2025, they cut the cost of serving Gemini by 78%. And this is where an economic principle from 1865 explains this entire video. It's called the Jevons paradox. William Stanley Jevons observed that when steam engines became more efficient at using coal, England didn't consume less coal. It consumed dramatically more. Because as it got cheaper, steam became viable for hundreds of uses that had never justified it before. Lowering the unit cost doesn't reduce total spending, it explodes it. And Google's numbers are the cleanest demonstration of that paradox that exists. 2 years ago, they were processing 9.7 trillion tokens a month. Today, they process more than 3.2 quadrillion a month, a more than 300-fold increase. AI answers in search reach 2.5 billion people every month. The Gemini app went from 900 million monthly active users in May to 950 million in July. 8.5 million developers build on their models. And their security architecture blocks 10 million spam emails every minute. They cut the cost per token by 3/4. And their total compute bill went up anyway because volume multiplied faster than price fell. That's the technical answer. It worked. And that's precisely why the financial answer is terrifying. Let's go to the July 22nd report. Revenue for the quarter, $119.8 billion, up 24% year over year. They beat Wall Street, which was looking for around $117 billion, and net income, $112.1 billion, a 298% jump from the year before. Reported earnings per share, $9.11 against the $2.87 analysts expected. That isn't a good quarter. That is, in all likelihood, the most profitable quarter any company has ever had. Except it isn't. Buried in the report is one line that changes everything. Alphabet booked $99 billion in gains on equity securities, roughly $98 billion of which were unrealized. Unrealized means exactly what it sounds like. Not $1 came in. It came from 2 bets. SpaceX. Google invested about $1 billion back in 2015 when the company was worth $12 billion. On June 12, 2026, SpaceX went public at a valuation of roughly $1.77 trillion. As of June 30th, Alphabet's stake was worth $94.1 billion. And here's the detail almost nobody reported. It can't sell a single share. About $80 billion is under short-term post-IPO sale restrictions. Another $14.1 billion is locked up through late 2027. And SpaceX stock has already fallen since June 30th, which means that number will be smaller next quarter. The second bet, Anthropic. Alphabet holds a significant minority stake. During the quarter, Anthropic's private valuation went from around $350 billion to $965 billion after a funding round. And this is worth pausing on because there's a circularity here that makes more than a few analysts uncomfortable. Alphabet invests in Anthropic. Anthropic pays Google Cloud for compute. That consumption helps Anthropic be worth more. And Alphabet books that increase as its own profit. None of that is illegal or hidden. Accounting rules require companies to mark their equity stakes to market every quarter and run the change straight through net income. Before 2018, those swings never even touched the profit line until you actually sold. But the rule cuts both ways. The same mechanism that manufactured a $99 billion gain will manufacture an identical loss if those valuations come down. So how much did Google actually earn? Strip out the accounting gains and adjusted earnings per share was $2.85, slightly below the $2.89 expected. And operating income, the measure of the actual business, grew 30%, not 298. 30% operating income growth at this scale is excellent. It just isn't the headline that went around. Everything I've described, the models, the chips, the data centers, the network, shows up condensed into a single line of that report. Google Cloud. Revenue for the quarter, $24.8 billion. Growth, 82% year over year. To put that in perspective, look at the trajectory over the last 3 quarters, 48%, 63%, 82%. A business this size is supposed to decelerate. The law of large numbers demands it. This one is doing the opposite, and it isn't buying that growth with discounts. Cloud's operating income went from $2.8 billion to $8.8 billion in a year. Operating margin jumped from 20.7% to 35.6%. It nearly doubled in size and got substantially more profitable at the same time. That's rare, but the number that matters most isn't on the income statement. Google Cloud's backlog, signed contracts whose revenue hasn't been recognized yet, hit $514 billion. A quarter ago, it was $460 billion. A year ago, it was $106 billion. $500 billion of work already sold and not yet delivered. Management expects to recognize a little more than half of that as revenue over the next 24 months, and there's a new sentence in the segment disclosure worth reading slowly. Google Cloud product revenue comes primarily from sales of TPU systems. This is the first quarter Alphabet has recognized revenue from selling its chips directly. For 10 years, TPUs were something you could only rent. Now they're being installed in data centers Google doesn't operate. Neither Microsoft nor Amazon sells its own silicon that way today. And according to the CFO, the majority of that TPU revenue will be recognized in 2027, which means this quarter you saw roughly the first inch of that curve. Now, the part that sank the stock 7%. Alphabet spent $44.9 billion in a single quarter on land, buildings, chips, and cooling systems, more than double the same quarter a year earlier. Roughly 60% of that goes to servers and TPUs. The remaining 40% to data centers and networking. And they raised capital expenditure guidance for 2026 from a range of $180 to $190 billion up to $195 to $205 billion. That's the second increase this year, and management has already warned that 2027 will be significantly higher. For context, at the midpoint, that spend equals roughly 42% of annualized revenue. That's a ratio you see at a telecom or a utility, not at a software company. The result was historic, and not in the good way. Operating cash flow for the quarter was $39.1 billion, up 41% year over year. The core business is generating more cash than ever, but capital expenditure was $44.9 billion. Subtract one from the other and you get negative free cash flow of $5.9 billion. The first in the company's history since its 2004 IPO. The prior quarter was positive $10.1 billion. The same quarter last year, positive $5.3 billion. And CFO Anat Ashkenazi didn't soften it. She said, free cash flow will remain under pressure, driven by investment in technical infrastructure. How are they funding it? With the balance sheet. $49.6 billion raised through an equity issuance in June, $20.3 billion in senior unsecured notes, long-term debt of roughly $98.2 billion against about $16 billion a year ago, and they suspended share buybacks during the quarter. That last one is the most honest signal of all. Buying back stock is what a company does when it has no better use for its cash. Stopping is an admission that it has a much better use, and that it needs every dollar. So what's actually happening here? There are 2 legitimate readings of the same report. And honestly, both are defensible. The bull case, Google is converting cash into capacity and it has the contracted demand to prove that capacity will get used. $500 billion of backlog isn't a projection. Those are signed contracts. Cloud is accelerating to 82% while margins expand. They've started selling their own chips to third parties for the first time, and that curve is just beginning. And they're the only company that controls every layer, which means every efficiency gain stays with them instead of being shared with the supplier. Negative free cash flow isn't weakness. It's a company whose demand exceeds its ability to build, choosing to build. The bear case. All of that depends on AI demand following this curve for years, not months. Capital spending already exceeds operating cash flow, and it's set to grow further in 2027. Debt multiplied roughly 6-fold in a year. The record profit in the headline was almost entirely an accounting entry, and it can reverse as easily as it appeared. SpaceX stock is already below the price that gain was marked at, and a $514 billion backlog assumes no customer renegotiates, cancels, or consumes less than committed. On top of that, management admitted it's capacity constrained, which means they're currently selling something they can't yet deliver. What isn't in dispute is this: Alphabet has stopped being an advertising company that also does AI. This quarter's financials are the financials of an industrial infrastructure company. Infrastructure margins, infrastructure capital intensity, infrastructure payback cycles. The market hasn't decided how to value that yet, which is why the best quarter in its history ended with the stock in the red.